Hi there and welcome. Michael Beresford is my name. I'm the Director of Investment Services here at OpenCorp. And I've got a couple of really special guests with me today, Christian Paterson and Amanda Gleig from our team at OpenFinance. Welcome, guys.
Thanks, Buzz.
Excellent. For those of you that are regular viewers to our monthly webinar series, you'll know that we love to bring the data and the information to you in a way that's easy to understand and keeps you focused on the essentials that drive movements in the property market. We're not interested in the headlines that create hysteria. It's all about where does the rubber hit the road, what's the important stuff to understand. And unless you've got oodles of cash and you can buy a property outright, most people we know need to get a bank involved and borrow money as part of that process. So that's what we're going to be focusing on today, the property financing essentials, and specifically looking at 5 key components to that, which has been driven by the feedback from you guys, our viewers. We've got some common questions that I'll be asking Christian and Amanda, and we'll be working through that as well as explaining some key concepts around leverage and other people's money, as we call it, finishing off with a snapshot around what exactly OpenCorp do, how we help you, and what your best next steps are from here. At this point, I do have to say that clearly, while we're talking about finance and money, the best that we can do in this kind of situation is be general in the nature of the advice that we provide and the insights that we give. Everyone's individual situation is going to be different. So one of the things that we're offering at the end of today is a chance to sit down with my team and I to understand what does your individual situation look like, what's the kind of position that you're in, and how can you best put some steps in place to be able to get ready to start or continue your investment journey. So if you know that that's something that you want to do, don't hesitate. Click on the link to request your individual strategy session and our team will be in touch with you. But really, what we want to be going through today are really important things that you have to keep front of mind to make sure that you are creating the right kind of financial structures to be able to build a portfolio of investment properties. As I'm sure you guys would agree, it's a very, very different landscape, getting a low interest rate home loan for your own place, as opposed to getting the right kind of structures that allow you to be able to add to that portfolio and build a substantial portfolios of property. Okay, great. So let's get into some of the nitty gritty that everyone wants to know around finance and important things that investors need to know. As I said, we've got Christian and Amanda with us from OpenFinance. A little bit of background to you guys. Christian, you've been in broking for 15 years. You're our operations manager at OpenFinance and basically run the ship that is all things lending at OpenCorp.
Very exciting times. A lot ahead for us.
Yeah, great. And Amanda, I hope you don't mind me saying you were a client of OpenCorp before you joined the team.
Yep.
A superstar of what you do. Amanda averages 9.8 out of 10 on her monthly CSAT month in, month out. So we've gone straight to the top. We've brought the best. No one better to be hearing about all of this finance stuff than from Amanda. You've been broking for 7 years? Yep.
Yeah, so love the world of finance and helping clients to navigate the interesting world that we find ourselves in at the moment and really bringing these investment dreams to fruition.
And it's a constantly changing environment, isn't it? Like we speak on a daily basis around our clients, but it seems like on a daily, weekly, fortnightly basis, something's changing. It's impossible for all of our viewers out there to be across what's happening in the lending market. Even if they're looking at things consistently, it just unfolds so much more quickly than that, doesn't it?
Absolutely, and it's really important to get the right guidance because, if something that might have been true 6 months ago, it's definitely no longer true today. So, we're staying across that and we're able to, help people navigate that world.
Yeah, awesome. So let's kick off. Point number 1 is OPM, as we call it, or other people's money. Now, I've got a question for you guys. I might just give everyone a quick summation on what other people's money is. It's basically leverage. For those of you that are familiar with Cam's book, one of many of Cam's books, the bestseller, My 4-Year-Old, The Property Investor, Cam uses an example there of shares versus property to explain the power of leverage. Now, in effect, part of the reason why we love investing in property is that we can borrow more of other people's money. So what that means is we can put in less of our own as a deposit, we can borrow more from the bank, and that gives us a greater asset value that we then get growth on. So, for example, let's say that we look at property versus shares. Let's say that we can borrow 90% of the property value in a loan from the bank. We could only borrow 50% of the share portfolio value from the bank. But in both cases, we're putting in $50,000 of our own money as an example. So in the property scenario, if we put in $50,000 of our money as a deposit, but we borrow the other 90%, being $450,000 as a loan, then we've got $500,000 of asset value that's growing for us over time. Now, if we look at the share scenario, we've got $50,000 of our deposit. We can only borrow 50% of the share portfolio's value. They're the bank's rules, not ours. That means that for the same amount of money in, you've got a $100,000 share portfolio compared to a $500,000 property. Now, let's say that in the property scenario, we achieve an inferior capital growth rate per annum at, say, 8% per annum over the long term. In the shares scenario, let's say that we get a superior capital growth rate at, say, 10% per annum. Now, if we look at 8% compounding year on year over 20 years, then our $500,000 property today is worth over $2 million in 20 years from now. In the share scenario, if we get a 10% compound growth rate on our $100,000 share portfolio, it's worth just over $600,000 in 20 years from now. So not a topic for today's webinar, but plenty of video content from OpenCorp on our YouTube channel around compound growth and what it is. That is the secret to wealth creation. Check it out. But basically, because we get better leverage or can borrow more OPM, we get a much better compound growth result over the long term. And that's just on one property compared to the share portfolio. What if you had 2 or 3 or 4 and those numbers multiplied on top? So there's a snapshot on other people's money. So I guess, Christian, question for you. Why is leverage the X factor?
Well, it's so powerful to get into the market. Most people have this philosophy that they need to save a 20% deposit. The reality is it's taking longer and longer for people to save a deposit. By the time they do save the 20% deposit, that property that was 500 grand is quite possibly 6 or 700 grand. So getting into the market in a quicker period while paying some sort of mortgage insurance or something like that is beneficial for all Australians.
Yeah, I couldn't agree more. Avoiding LMI at all costs is one of these things that's in the popular media. Yeah. Maybe for our viewers, Amanda, what is LMI and how does that work?
Yeah, so LMI is something called lender's mortgage insurance. It's insurance that you as a borrower would pay to borrow that money from the bank. It's actually an insurance policy that protects the bank. So the bank's going to lend you, Michael, say 90% of the value of the property that you're purchasing. The property market, for some unknown reason, potentially went down by 5%. It's quite a risky loan for a bank. So the bank insures themselves so that if for some reason the loan that they're lending you becomes less than the value of the property, they're able to claim that difference back from the mortgage insurer.
Right. So in effect, it's a loan cost that the borrowers incur. It is important to note that for investment, it is tax deductible.
It is.
I'm happy to say I've paid LMI on over 80% of my personal investment portfolio because it just allows me to hold more asset more quickly, to your point. Christian?
And it's really important to, getting into the next property a lot sooner. Waiting for that equity at 20%, you might be waiting years. So getting into that property in a quicker period, you're going to see faster growth and your net wealth increase.
Well, at the moment, we're seeing, properties jumping up tens of thousands per week.
Every week.
It kind of feels like.
Yeah.
So, to give, I guess, our viewers some understanding of the amount of LMI, if they were borrowing, say, $500,000, how much would their LMI be approximately?
Average cost of a mortgage insurance premium on a property like that would probably be somewhere between $10,000 to $11,000. So depending on the bank, somewhere between $10,000 to $11,000 would be a rough estimate.
Yeah, so let's map that out. So let's say that you had enough deposit to be able to look at 1 20% deposit or 2 10% deposits. In the scenario with 2 10% deposits, you'd incur 2 lots of $10,000 apiece, round numbers, in mortgage insurance. Now, with lender's mortgage insurance being tax deductible, let's say you're on a 37% tax rate, the real cost of that LMI is not $10,000 per property, rather $6,300.
Yep.
If you've got that twice over, let's say that that's $13,000 as a round number in LMI, the market's moving by that per week, per fortnight at the moment.
Yeah.
So
It doesn't take you very long to make that money up.
it doesn't, absolutely.
Yeah.
And while you might want to avoid it on your own home because it's not tax deductible, very, very different story for investment. And that's part of the reason why we've got you guys here, because only 10% of the Australian population invest, right? So the way that we're taught to think about money, especially debt and borrowing, is very, very different in the investment sphere compared to the owner-occupied sphere.
And I always say to clients, LMI could be the best money that you ever spend. And it also gives clients full control and flexibility around their cash. They can choose even when they choose to pay that property down. But if it is their goal to keep investing and to build a portfolio, which is what OpenCourt helped them with, that money could be the difference between, getting into the next property or not. So great use of funds.
So another question for you, Amanda. How do we best harness other people's money to get the best results?
Yeah. So, Michael, you talked before in relation to Australians being brought up a certain way to believe that debt's the devil and that it's really important to pay down the debt that you have on your own home. And I've talked to clients all the time about good debt and bad debt. Investment debt actually is really good debt. It's debt that's actually helping you to build towards your future. And it's not really the level of the debt that's so important. The cash flow is probably more important. And so how much can you afford to be directing towards those repayments? And what's the cash flow looking like on the properties that you're holding? And Michael, you can probably address that some more.
Yeah, I will in a second. It's a really good point. Just for everyone out there that might not know what's good debt and what's bad debt, can you explain that?
Yeah. So bad debt we term as personal debt. So debt that you might borrow on a credit card, debt that you might have for a car loan or a personal loan. It could be even debt that you've taken out for underperforming shares or something like that. So debt that's not actually helping you get further towards your goals, debt that's not tax deductible, and debt that doesn't help you get into a better financial position. Good debt is debt that we would term tax deductible debt, or debt that you're actually using to leverage towards your goals. So when we're investing in property, that debt is something we call good debt. And it's something that, generally has a benefit to the person who holds that debt at the end of the day.
All of our regulars will know Cam's stolen one of my sayings. He's not here to defend himself, so I'll claim it as mine, which it rightfully is. Drive the cheapest car your ego can handle. Not only have an expensive car, but if you've got a bad debt loan that goes with it, it's obviously impacting your borrowing capacity, which we'll get to shortly. But I think the point that you made around it being less about the debt amount and more around the cash flow is really important for everyone to understand. So I might just walk through that briefly. Because 90% of the Australian population don't invest, the loan and the debt that most people are familiar with is the debt on their own home. And as all of us mortgage holders out there know, the only source of cash flow that we've got to repay that mortgage and service the loan is coming out of our pockets post-tax. So 100% of it is coming out of our post-tax income. With the investment properties, on the other hand, I consistently explain it, like each property is giving us a $30,000 to $35,000 pay rise in the form of rental income being paid by the tenant and significant tax benefits that come back to us from the government. So while we're taking on a loan of, say, $600,000 or $700,000, for example, we're actually getting all of this extra income to service that loan, and absolute worst case out of our pocket, it's costing us $50 a week. So I talk to people on a daily basis around the fact that they think investment is more risky than their own home. That's purely an emotional thing around comfort. From a cash flow point of view, paying your own mortgage 100% out of your pocket is much more risky from a cash flow perspective than what it is to hold a property where the majority of the holding costs are coming from the tenant and from the government.
Absolutely. And with interest rates so low at the moment, those holding costs are definitely significantly lower than they have been in the past as well.
Yeah, in reality, any property today will pay for itself, right? 100%. We just like to be conservative and build in buffers. So that's probably a really good lead-in to borrowing capacity. We put a lot of emphasis on borrowing capacity and specifically how to maximise that. The question I've got for you guys is, why is borrowing capacity different from one lender to the next?
That's a really good question, Boz. A few of the main points, the reason why borrowing capacity is different. Every bank will have a different policy and servicing rate. The assessment rate could be higher with Bank X and Bank Y. They could look at your living expenses in a different sort of manner and also service our other liabilities at the same time. So it's really important to consider different lenders to maximise your borrowing capacity in some instances. Did you have anything to add to that?
Yeah, I think it's really important that people understand that lending is not a one-size-fits-all kind of approach. I wish that it was, because it would make our lives so much easier. But every time we kind of speak to clients, it's really important that we understand not only your financial position, but future goals and dreams as well. So when we're looking at borrowing capacity, it's really important that we understand not only what bank suits you right now, but if your goal is to keep investing and keep duplicating, we also want to understand what bank might suit you within the next 2 or 3 years. So borrowing capacity, we need to look at on a holistic, level and really understand the ins and outs of that. Some people are employed casually. Certain banks only take maybe 48 weeks worth of casual income. That's because people don't have sick leave or annual leave that goes along with that. We've got some banks that don't like people who have novated car leases or people that have different deductions and things coming out of their pay. So every person's circumstance is really different, and it's important that we know all about their financial circumstances to guide them around that.
What I'm hearing is it's just another example of having the right mindset.
Yeah.
We consistently talk to our clients about the fact that you need to be a little bit of the black sheep to be a successful investor, because so few Australians do it. Mm-hmm. It's not how we're brought up. The concepts aren't overly complex, right? It's just that we're not taught compound growth at school, mm-hmm. And lending's very much the same. And I guess, hats off to the marketing geniuses when I was in primary school and Commonwealth came out with their Dollarmite account, right? Because that's, effectively locking you into a branding relationship with Commonwealth for your lifetime.
Yeah.
So it starts with saving, and it obviously gets to a loan and credit cards and all the things that make the bank's money further down the track. So kudos to them for that. But if we think about what's important here, our parents and business associates often talk about, I knew the bank manager back in the 70s and I've always dealt with bank X. It's a much more fluid market now.
Yeah.
You can get much better outcomes by being prepared to A, shop around a bit, mm-hmm. B, spend a little bit of time. I'm amazed. I talk to my mates, they're like, I can't be bothered, etc. I said, well, if it took you 2 hours of your time and I gave you $4,000, would you do it? They changed their tune pretty quickly.
Yeah.
Right. So I think it's a really good point. Be prepared to spend a bit of time and effort collating your documents. The brokers do all the heavy lifting, right? People don't have to go to all of the different banks themselves, but just tweaking those little knobs on a consistent basis to get better outcomes consistently can make a massive difference over the long term with your portfolio.
Absolutely.
I'd like to add to that is I always say to all of our clients is there's no loyalty in banking. You could be with the same bank for the last 10 or 15 years, but if they're not going to give you the serviceability to buy that next property, well, are they really the right bank for you? So you've always got to keep an open mind, especially while you're looking to grow your portfolio.
Go where you can get the money.
Absolutely.
So there's a really key takeaway point for everyone watching. Interest rates have come down in the last 2 years. There are some amazing deals out there. The volumes that you guys have been writing are off the charts, mm-hmm. Not only with new purchases, but helping people refinance and save a lot of money. If you have had your loan for the last 2 years or more and you haven't reviewed it, that is the number one thing that you should be doing right now, is reaching out to have your borrowing capacity assessed and understand what the opportunity is to refinance at a minimum and save yourself some money on your existing lending. If you have looked at your borrowing capacity within that time frame, you've reached out to your bank or a broker who's not experienced with investment. As Amanda said, there are a whole range of variables here. Even brokers are like doctors. Some are specialists on home loans, some are investment specialists, some are equipment and finance specialists, right? Everyone's got their place and can provide some specific value to you. If you've been to your broker or to a bank and been told that you haven't got the ability to refinance or you haven't got the borrowing capacity and you wanted to add to your portfolio, again, click on the strategy session. It won't cost you anything. Our team will be in touch. We can get a snapshot on your situation and just give you the expert advice on what might be possible. So you can save some money as a minimum, add to your portfolio at a maximum. So the number one thing when people talk about loans are good old interest rates.
Yay.
The way that we're brought up to think about interest rates is the low rate is the be all and end all. Where would you guys put interest rates in the pecking order of important loan features?
The absolute last.
The way you two looked at each other, I'm like, this is going to be controversial.
It's so interesting. It's the first thing everybody will always say to you is the most important thing to me is interest rates, but they don't realise it's probably the smallest piece to a very big puzzle.
100%. And like anything, Michael, in some things you do get what you pay for. And when we're investing, there are definitely a lot of puzzle pieces that need to fall into place before we get to an interest rate. So having a low interest rate obviously is beneficial, improves cash flow, gives us a nice money back in our pocket. But yeah, it's definitely not the most important piece of the puzzle.
Yeah, and let's put a caveat on that. We're not talking about, current home loan rates versus something at 5%.
No,
everything's competitive,
100%.
right? That you would recommend. But what are some of those puzzle pieces and why are they more important to investors than interest rate?
One that we always touch on is valuation. 6 different banks could send out 6 different valuers and they could have 6 different opinions. So if equity is one of the final pieces in getting your next investment property, valuation is very, very important.
Yep.
Absolutely. Policy can definitely be really important. So some clients earn commissions or bonuses, some can be overtime and allowances. There are certain banks that will use 100% of that income, other banks that will shave that down to 80%. So knowing which banks will actually give you the most amount of borrowing capacity can also be really important when we're talking about lending.
And probably the last one for us at the moment is probably turnaround times. At the moment, it's been well publicised in the media. Turnaround times are exorbitant. They're completely blown out. So with a market that's moving so quickly at the moment, trying to get your loan approved in a quicker manner and having a marginally different interest rate, getting the property is more important than saving a little bit of money on interest.
Yeah, no point going back to your best mate at Bank ABC, right? I won't name any, that have a 40-day turnaround if you've got settlement in 30 days, right?
Totally.
Doesn't work.
Square pegs and round holes. Yeah. But I guess just to help people understand, we know this because we talk about it all day, every day. But just to help our viewers out there, there's a client that we're working on together, Amanda, and their borrowing capacity has varied by nearly $1 million because so much of their income is around bonuses and incentives.
Yeah.
So that's the difference between not just another one property, maybe another 2 properties. Map that out over a 10 to 15 year period in terms of, imagine if you bought another 2 properties 15 years ago and how much extra wealth that would have created for you. We're talking about hundreds of thousands of dollars, if not millions of dollars here. Hopefully, the message is getting across that 0.1 or 0.2 or 0.3% on interest rate is small fry compared to that overall outcome that people can achieve.
Yeah. I think a lot of people, when they're borrowing, look to banks. And, the big banks are obviously very well known in Australia. They still have, I think it's 50 or 60% of the market share. It's something crazy. We do also have a non-bank segment as well. And our non-banks are still governed by a body called ASIC compared to the banks that are governed by a body called APRA. The non-banks don't quite have the same level of second-tier regulations that the banks have. So it can make a very big difference to the type of rent that they'll allow us to use, to the negative gearing, and also the buffers that they put in place on top of living expenses and things like that. So for some clients, it can be as simple as using a non-bank instead of a bank, and that can improve borrowing power potentially up to a couple of $100,000.
Yeah, so it's so important if you're out there. The lending landscape can be daunting. Banks are big organisations. It can be scary. We understand that. It's like kind of, I did a 1,000-piece puzzle in the middle of COVID when we were in stage 4 lockdown. You pour all the pieces out, you're thinking, where do I start? Right? Where you start is by getting in contact with us, clicking on the button, share your information with us. We'll help you understand your borrowing capacity. And be able to give you that landscape across a whole range of lenders, help you understand the pros and cons as opposed to just dealing with a bank that you might be familiar with.
Yeah, absolutely.
So we've talked about some of the puzzle pieces just now around what people need to be looking out for and what can influence their borrowing capacity to different levels. Understanding everyone's situation will be different, obviously. What are some of the kind of key headline items that everyone can be looking at to improve their borrowing capacity?
So I think one thing that people can look at is, we talked about good debt and bad debt before, so definitely any of the bad debt that they hold. So if you do have credit card limits, for example, every $1,000 of a credit card limit can take away up to $6,000 of borrowing power. So if you've got credit cards that you don't need and you're not using, potentially be prepared to close them. Or if you've got debt built up on credit cards or some car loans and things like that, one of the things you could do is to aim to pay those out as soon as possible.
Another one that's really important is living expenses. The banks are looking at people's discretionary living expenses and all living expenses more and more closely. So minimising your spending as you're looking to purchase a property is really important for most people to increase their borrowing capacity.
What's the time frame that banks look at, Christian, on living expenses?
Depending on the banks, but anywhere from 3 to 6 months.
Right. So it's not forever. It's just be really, if you're close on borrowing capacity and you just need a little bit extra, be really discretionary on what you're spending for a 3-month period.
Yep.
Your statements will look really good. Go back to living the lifestyle you want after you've got the approval, right? Let's be honest, right?
Yeah.
Banks build in enough buffers. We all know that. We don't have to keep ourselves conservative. They do it for us. Anything other than living expenses and being particular with that and credit card limits?
Look, I mean, the only two things that people really have or control or influence over are really the income coming in the door and then the expenses, the liabilities going out. We've got some clients who rent very, very nice houses. So weekly rent can be quite expensive. So some clients might be prepared to look at renting in a cheaper place for a short period of time, again, just so that we can increase borrowing power. So we could have a look at reducing expenses, living expenses, rent, definitely cutting down on liabilities where possible. The other thing I'd say clients do is potentially look at extra income. Now, obviously, people have only got a certain amount of hours in a week, so not everyone can go out and get a job that is going to pay them more money, but people can start businesses on the side. I've got some clients who've gone out and started drop shipping businesses or things like that, that are actually now bringing in somewhere up to $80,000 or $90,000 as a second business. So all of a sudden, that's another property that they've been able to secure just by thinking outside the box and trying to generate some more income.
So I think that the key takeaway is we're not talking about people living on baked beans and cat food and not having any holidays for the next 30 years, right? What we're talking about is understanding what those influencing factors are and being able to make informed decisions around how you can improve your borrowing capacity if you are wanting to add to your portfolio.
Yeah, absolutely. And I think that's the thing. Ask the right questions, understand what you can and can't do. And if there's anything that you can change and that's really important to you to obviously achieve that goal, then start it today. And don't wait too long to implement those changes.
And the credit card one's really important, isn't it? Because if you have refinanced consistently, a lot of the time banks will give you a credit card. You might not even know you've got it nor even use it, but the limit's still there on your credit report. So that's a really easy fix that makes a massive difference. $10,000 in credit card limit, about $60,000 in borrowing capacity. It adds up pretty quickly.
Really
so
does.
That's a really good first step for people out there as well.
Yeah.
So you mentioned valuations before, Christian, when we were talking about those different puzzle pieces that fit into the mix. Can you maybe elaborate on why valuations are so important? And when you're talking about equity, just explain what equity is.
Thanks, Boz. Equity is the value of the property less the loan. The figure in between that is the equity. The equity is the puzzle piece that allows you to grow your portfolio. Every new property you want to purchase, there's always going to be a deposit and associated costs. As your debt comes down and your valuation goes up, the equity grows. So as somebody's equity grows, that's a great opportunity for them to then buy the next investment property.
Yeah, it's often not well understood. Like I had an appointment this morning where clients had some cash in an offset account. They thought that cash was going to be the deposit and costs for an investment, but I showed them how they could reduce their bad debt on their own home, utilise the available equity, and that equity could be the deposit and costs for the next property. So for those of you out there that worked really hard to get into your first property, whether it be your own home or an investment, it's a battle, right? It's really hard. But once you're in the market, it becomes so much more easy because you don't have to save a whole nother deposit. You can use the bank's money or other people's money, leverage, to access that equity to cover the deposit and costs. So if you've ever heard things like, buy a property with no money down, words to that effect, that's how we do it. Is we use the equity to cover the deposit and costs to duplicate and add to our portfolio. We're not having to use cash for deposits every single time. So clearly, valuations are a key puzzle piece. We're working on a client at the moment, maybe don't share names, but examples of what we found with different valuations on their portfolio.
So this client just recently completed a property with OpenCorp and we got 3 valuations done on the property. Lucky for him that the property had gone up nearly 15% since he signed the contract and completion. with that growth, it's allowed him to have the equity, which is essentially the deposit and the cost for his hopefully third investment property, which is exciting times for him because he wouldn't have been able to save that money in the year it's taken.
Yeah, and why did we get 3 valuations?
As we mentioned a little bit earlier, is valuers all have a different opinion and banks will utilize different valuers. So it's getting 3 different valuers to get the same opinion. If our life would be a lot easier if everybody had the same opinion, but they don't.
Yeah.
And then pulling that lever to then utilize that equity to buy an investment property is a really important piece.
So let's give everyone an example. It's pretty common, isn't it, to see valuations on the same property vary by 20 to 40,000.
Even more than that, Boz. I had one
Really?
the other day vary by 150,000, and I'm not talking on a $2 million property. I'm talking on a $700,000 property.
Yeah.
So yeah, this particular client we knew roughly was probably worth about 700,000. I had one valuation come back at 550. I had one at about 650, 660, and then I did get one to finally come back at 700,000. But obviously, it's a clear choice for the client as to which bank they're going to use, which is based on the valuation. It's not based on the rate. It's not even based on too many other things. It's which bank is going to allow them to take the most equity out, which actually funds that next deposit and costs.
Yeah, absolutely. So even if we don't have as big a variation as that, I think it's important to understand that a valuation is purely a subjective assessment from one person. Right now, if the 3 of us are valuers working for different firms and we're valuing Cam's house, right, we've got 3 different opinions.
Yep.
It doesn't change the market value of that property.
No.
It's just a valuer's assessment. But it does massively change. Being prepared to look around and get different results can massively change the amount of equity that's available. You know, on an 80% lend, being pretty conservative, if you get a $30,000 difference in valuation, there's another $24,000 of available equity, you know, towards the next deposit. So it's well worth looking, you know, beyond the first opinion.
Yeah.
Be prepared to shop around, be prepared to look at that because, again, it can really make a big difference to when you can duplicate, and the sooner you're in the market, the more compound growth you're getting, especially in a moving market like right now.
Yeah, and I think just talking to your point, Boz, it's really important that in that case you do get some expert advice and brokers that really do understand the power of equity, because if you are going to brokers who potentially are assisting you to help or helping you based on rate, and aren't considering the factors of either borrowing capacity or, more importantly, equity, you could get told that you can't duplicate when in fact you potentially could.
Yeah. And so it's probably a relevant point now to be talking about cross-collateralisation. It's a very easy way for brokers to set up finance. It requires the least amount of effort. The same lender, it's very easy. You know, compared to the more time-consuming way that we want to set finance up. Why is cross-collateralisation an issue for investors?
I hear that word, Christian, and I just cringe.
Because it's hard to say.
You know, cross-securitization, cross-collateralization.
Yeah.
To me, it's actually more work to cross-securitize things because I am looking towards the end goal, which is the actual untangling on all of that. But cross-securitization, essentially, banks and brokers use to keep clients sticky. So it's all about tangling the most amount of properties and debt up that make it really, really hard for clients to untangle. So all it is simply the bank having, say, 2 properties that they use as security for one loan. So you might take a loan out for $1 million and that might be secured by both your own home, which might be worth $600,000, and an investment property that might be worth, say, $600,000 as well. So rather than having 2 loans, one secured by each of those properties and them having totally standalone securities, totally standalone loans, cross-securitization is just simply tying the 2 of those properties together and having one loan that's secured by both.
Yeah. I'm sure we'll unpack that a bit more in the pitfalls, but especially around the valuation, you know, there's no transparency or awareness of what the valuation result is. When you cross-collateralize, the bank just says, yes, approved. We've got no idea what the properties have been valued at. There's no disclosure around that, like we have when we go to different lenders and get different results.
Totally. I believe when I think about cross-securitization, it's a prime example where the banks are just looking after themselves. They're de-risking their portfolio, increasing your risk because you have less flexibility. The reason why we always talk about not cross-securitization is looking at different opportunities to go to different lenders when you choose to, not when they choose to.
Yeah, really, really important.
Yeah, and I think it's important to understand as well, and we might talk about this in pitfalls, but it can also mean if you were to sell one of those properties that is cross-secured, the bank actually has a say in what you do with that money. And I have a client at the moment where their own home is almost unencumbered. There's probably only maybe $50,000 worth of debt that's linked to that. They would like to sell their property and they'd like to take all that money to go and buy more investment properties. The bank's actually saying no, they can't do that because they're not prepared to lift the loan to value ratio or the risk on the owner-occupied property that's left with the bank. So it gives the bank an awful lot of control and it takes all the power away from the borrower.
Yeah. If you're starting to get the gist that finance structure is really important to building an investment portfolio, that's exactly what we're talking about. And in the individual strategy sessions that my team take everyone through, there's a specific section there on how to structure finance. The three key parts being security of your own home, which we'll elaborate on, the control and flexibility to refinance and have the choice around what you do with your money, and third, transparency around valuations. So we'll elaborate on all of these things in the individual strategy session. Click on the link if you want one. Leave your details with us. Our team will be in touch. But let's go back to equity for a second. How do we best access it? Like, what are the actual steps that someone would go through? You guys do it on their behalf, obviously, but what's required to access equity and get a loan approval?
So the process that we utilise in OpenFinance is getting a valuation and then assessing the borrowing capacity. Then we'll join those two pieces together and you'll speak to one of our qualified mortgage brokers and they will provide recommendations on which lenders will allow you to access different amount of equity and then working towards the end goal in mind. We see way too often that mortgage brokers are just looking for the one and done, or same with the bank, but they're not thinking about the end goal and what we're working towards. Sometimes brokers will suggest a client fix their loan for a prolonged period of time, meaning they're unable to go to a different bank with a higher valuation, with more equity, without incurring significant fees or costs.
So in terms of, if I was a potential investor, I've had a valuation done, I've maximised the amount of equity, I understand what the loan product and the recommendation is about, I've worked through that. It's not something that happens overnight, right? Like what are the timeframes and so on required to establish that equity loan? To have available funds for deposit and costs?
Look, at the moment, Michael, the banks are incredibly overwhelmed with the, volume of business that's coming through at the moment. So with certain lenders, it can take anywhere up to 8 weeks to get a loan approved and then probably anywhere up to another 4 or 5 weeks to settle. So it is going to take some time depending on the bank that you're with, and depending on if we have the ability to choose banks that have shorter turnaround times, or if we're chasing banks that have got the better valuations. So in the best case scenario, if you came to me and I had a bank that had an approval time of a week, we could probably have your equity in your bank account within 2 to 3 weeks. In the worst case scenario, that actually could be closer to 2 to 3 months.
Yeah. So if you're thinking about looking at a property this weekend, please don't call a broker on a Thursday night and hope that everything will be done pronto. It does take some lead time. It does take some planning. But as we've been highlighting, well worth a bit of effort to get it done right for not only the best outcome in terms of available equity, but the best kind of loan structures and so on, to be thinking about the subsequent steps while our clients are wrapping their head around the first step. So we said today that there were 5 keys to success in today's market. We've been through 4. The 5th one, pitfalls to avoid. So we've touched on a couple of these as we've gone, but I'd like you to elaborate on it. What are some of the common pitfalls that you see?
One of the biggest pitfalls is comprehensive credit reporting.
Say again.
Comprehensive credit reporting. It's a bit of a mouthful. Okay. What comprehensive credit reporting is your existing lenders will notify your repayment history over the last 2 years. There's a grace period of 14 days, but what it will notify in your credit file is if you're late in your repayments. Most lenders will look at this, and that could be the final carrot if they decide to give you a loan or not. People before had this thought that if they went to another bank, that the new bank didn't know their repayment history, but now there's more information on their credit files than ever. So it's really important that people actually understand their credit file and make sure that they're making their repayments on time. And if they're not, that they speak to their lender about hardship before it gets too bad.
Good advice.
I think another pitfall, and we touched on a little bit earlier, is definitely avoiding cross-collateralisation. But it's important to know that you can take equity out of your own property without putting your own home at risk.
Yep.
So what we like to talk a lot about is mitigating risk, or finding ways to diversify lenders in what we're talking about. A lot of big words going on today. And so it's important when we think through strategy and structure that we talk about how we can protect your own home. So when we take equity out of an owner-occupied property, or it could be your first investment property, what we generally look to do is then take a different loan with a different lender. So important that then if anything were to happen, if you couldn't make repayments on your investment property or something like that were to happen, wouldn't put your own home at risk. So people can take some comfort in the fact that we can definitely do that, and find ways to limit the risk or mitigate the risk on taking equity out of your own home.
And it's really easy to become cross-secured, isn't it? Because most people, motivated to improve their financial situation, have a home loan against their house, know they've got some equity, find an investment property, go, oh, well, I've got a relationship with X bank. They go to X bank and say, will you lend the money? And they just want it quick and easy. And that means quick and easy for the bank, cross-collateralised. As you said, it's very hard to unwind.
Yeah.
That equity in your own home can still be accessed to grow your portfolio. It's just that process of the equity loan and then a different lender, as you talked about. So it's really quite simple to avoid cross-collateralisation. Hopefully we've been able to articulate that process for you today so you understand just how easy it is, albeit in 2 steps rather than one.
Yeah.
Any other pitfalls for people to be aware of?
Yeah, I was going to say another one that we see all the time is people not factoring in the costs and things that come along with purchasing a property. So if I wanted to go out today and buy a $500,000 property, a lot of people think, oh, great, I've got a 10% deposit, I've got $50,000 ready to go. Unfortunately, that doesn't quite cut it, because the things that we've got to consider on top of that would be some stamp duty, some legal fees, some fees that we've got to pay to the government to transfer the property into your name. So generally we need to allow about 5% on top of the purchase price to cover those fees and charges. So really important that if you're looking to buy a property, you really do understand what the true costs are and what your true borrowing power is, and make sure that we've got the deposit and costs or the equity available to cover all of that.
Awesome. Comprehensive credit reporting, CCR, avoid cross-collateralisation, and finally, make sure that you are factoring in about 5% of the property value for costs. So there we have it, 3 key pitfalls to avoid, 5 key successes to be able to prosper in today's property market. Thanks very much for joining us, Amanda and Christian.
Thanks for having us, boss.
Thanks, boss.
So there we have it. That's the end of the webinar portion of Property Financing Essentials. We hope you've enjoyed it. But we're not done yet. We have got Q&A. Thanks to everyone who sent through a whole range of questions around a whole range of topics. We could be here for the next 5 hours if we were to answer them all, which we won't be. But we've got a few key ones that we think talk to the key concepts that we've talked about today. So Abby, over to you to run through the questions.
Sure. We've got a question here from Heather, who would like to know, if I have enough equity to borrow a deposit, can I then borrow against the asset without any serviceability issues?
So I guess the answer to that, Heather, is you need to have the borrowing capacity to borrow against the equity. So equity in our house effectively, I guess, is like stored cash. But for the bank to give us early access to that without selling the property to get the cash, we actually need to have the borrowing power. So 2 pieces to the puzzle. You need the equity, but you also need to have the borrowing capacity to borrow that equity.
Great response. We have another one here from Fabiana, who is a single person with 2 totally different income activities. So she said here approximately 45K per year as an employee, and then an additional 90K per year self-employed. She'd like to know if both of, do lenders consider both of those incomes at 100%?
The great news is, yes, there are lenders that will use both those incomes at 100%. It would probably more look to the policy and which lender you'd go to. Some lenders traditionally look at self-employed income, an average over the 2 years. Some lenders will look at the most recent year in isolation, which is really good if the income's gone up, and it might mean that you could buy your next property.
Thanks, Christian. Next question here is from Andrew, who would like to know line of credit versus offset account. What would you recommend?
So I think those are two separate things. A line of credit essentially works like a giant credit card. So the bank might approve you for a 100,000 credit limit, and that line of credit you can simply borrow, take money out of it as you need it, and you can pop money back into it when you don't need it. A lot of the time those lines of credit can be quite hard to come by, and they also come with quite a hefty interest rate. So a lot of the time you can achieve the same outcome, especially if you're going to be using the majority of the money almost immediately, just by taking a normal term loan and by making use of an offset account. So if I took out $100,000 as a loan today and I only needed to use maybe $30,000 to pay a deposit, what I'd do is I'd put the extra $70,000 into an offset account, and every day the bank would calculate interest for me and just charge me interest on the $70,000. So look, everyone's circumstances are different, but quite often we can achieve a better outcome for the client by setting up a term loan with an offset account rather than using a line of credit.
And to add to what Amanda just said is, if somebody's not diligent with their funds, they could sit back in 10 years' time and still owe that $100,000 by utilising a term loan. That loan should significantly have dropped.
Thanks, guys. We have a question here from Canoe, who would like to know, have the prices reached its peak, and what will happen if interest rates go up as predicted?
I might take that one, guys. Good question, Canoe. So I love it as an investor when interest rates come down, because it means the cash flow position of my portfolio improves. Might sound strange. I love it even more when interest rates go up, because it's important to understand why that's happened. So in short, we definitely don't think the market has peaked. The rationale for that is there's a lot of media commentary around booms and record price growth and all these kind of things. There are 6 fundamentals that drive property markets, and without going into all 6 in depth, one of them is lending policy. So without doubt, the interest rates coming down has improved people's borrowing capacity, which is contributing to this. But just remember that the banks are applying big buffers on top of actual repayments when giving borrowers money. So in effect, anyone that is borrowing money today, regardless of how much prices are moving, can repay that debt on a much higher interest rate than what we're actually on today. So that's the first thing to remember. Second thing, interest rates will definitely go up at some point, but they don't just go up because it's Monday or Saturday or Tuesday. They go up in reaction and response to a whole range of economic activities. So when interest rates go up, other things have to have happened first for the interest rates to follow, i.e. wage growth needs to be up, unemployment rate needs to be down, economic growth needs to be up. Their whole market demand needs to be up. Now, if all of those things are happening, then yes, the interest rate will go up, but your property will have grown in value as a result of that inflationary effect, and the rents that you're able to charge from your tenants will have gone up as well. Chances are your income's probably gone up as well, so you might be into the next tax bracket. So while it's easy to think about, again, in light of your own home, where you're covering all of the increase in repayment if the interest rates go up, with investment, it's probably only $5, $10, maximum $20 a week extra that it would cost you if interest rates were higher. I'd happily pay an extra $20 a week out of my pocket to make several $100,000 in growth that would have occurred for the interest rates to increase.
Thanks, Boz. That's a great answer. Steve would like to know the best way to structure a simple property portfolio between 5 and 10 investments.
Well, we love it to you, Amanda.
That's probably exactly what we've done.
Absolutely. So look, some of that depends on which properties have equity available in them. But effectively what we'd look to do is to take equity out of a property, say with Bank A, and then we'd look to borrow the purchase property with Bank B. So we try and keep as much as possible the lending separate. We'd always make sure that we've got separate loans for separate securities, and it really is rinse and repeat. The bank might differ depending on borrowing power and policy. Valuations, as we talked about, play a big key, but it really is a case of taking equity out of the property, borrowing up to 80 or 90% of the value of property A, fund the deposit and costs from that purchase with one bank, and then do the purchase loan with another bank to borrow the rest of the money.
Yeah, I think the one thing I'd add to that is in any investment journey, there are 2 stages. There's the acquisition phase, which is when we're working hard and using equity to lather, rinse, repeat, as you said, and grow the asset base. And then there's the consolidation phase where we're not continuing to add to our portfolio, but we're letting compound growth work its magic over time. Would we implement a different finance structure potentially when we get to the consolidation phase once the acquisition party's done?
Yeah, absolutely. So when we get to the consolidation phase, I guess it really is about holding costs and about really trying to reduce rates and repayments. Effectively, we might be looking to extend the interest-only term as long as possible. We might also start looking to pay down some debt. So it could be that we have a look at, targeting a loan, maybe some principal and interest repayments on part of a portfolio. It all depends on the client's goals and the overall, outcome we're looking to achieve. But definitely the goals change, and when goals change, plans and structures change too.
Sure.
Thanks very much. We've got a question here from Joanne who would like to know, are we better off to buy a property that needs a bit of work or one that needs no work? Comparing that with a unit, a townhouse or a home.
Wow. That's about 45 minutes, Joanne, so I'll try and give you the short version. There are two competing strategies that are often talked about when it comes to investment. Should I buy a capital growth focused property or should I buy cash flow focused property? At OpenCorp, we don't believe that you've got to sacrifice one for the other. You can have the best of both worlds. Simply put, to be able to create substantial wealth through property investment, you must have a capital growth focus. I would much rather see 50,000 growth in a year as opposed to $50 a week in positive cash flow. Okay, so that's the first thing. Got to have the focus on capital growth. Number one rule of property is that land appreciates and buildings depreciate. So it's an apartment-free zone here at OpenCorp, land-based investments only, because that gives us the investment in the part of the asset that grows in value. With regards to whether you should have an active or a passive strategy, that really depends on your skill set, your location, your access to trades, and a whole bunch of things. There are numerous ways to make money in property. The emergence of the block, makes everyone feel that they can make millions of dollars of profit in 6 weeks by doing a couple of pieces to camera and having a whole bunch of trades that do all the work for you that they don't pay for, mind you. So there is a bit of a bigger picture there to factor in. But I guess the limitations around renovation are that if you're going to be doing them yourself, you've got to really leave emotion out of it. Don't spend extra time, effort and money on creating something that you love. You've got to be looking at the numbers and making sure that you're able to come in at a certain price point, spend X amount, sell it for a much bigger profit. Check out one of our WODs on our YouTube channel around holding versus flipping, purely because how much profit you think you'll make is actually dwindled right down to this by the time you actually factor in all of the costs that you need to allow for. So we prefer holding the passive way. That allows you to be much more flexible about where you invest, diversify across different locations, suburbs, capital cities even as well. You've got a lot more flexibility. But that would be a classic case for let's look at your individual circumstance and skill set, request a strategy session, and the team will point you in the right direction.
Great. Another question here from Connie, who's recently started doing some contracting work, but already has 2 investment properties which are positively geared, along with a family home. How does she get finance for that next property?
That's a really great question. It's actually becoming more and more common. Most employers now, or government employers now, are looking more to take on contract workforce rather than a full-time workforce. The short answer to that is if you've been with your current employer for a minimum of 6 months, there's a number of lenders that will look to take that income at 100%. So there is a solution out there. You've just got to be speaking to the right team.
Great.
Great. Another question here from Frank. We know the market is on the rise, but with the introduction of immigration in the next year or two, how do we manage this impending rise?
Okay, so I think what Frank's getting there is the market's moving, and when borders reopen, there's no doubt that the government will grow the economy at a rapid rate and welcome this skilled migration. Australia's going to be a pretty appealing place to live. I'm sure people want to come here. I think it's important to remember, Frank, that just because the market's been strong for a 6-month period, it definitely hasn't been through a full growth cycle, especially in different locations and different cities. Some are towards the top, some are yet to move. So you want to get your property selection part very much right. But I think it gives us a lot of confidence around those fundamentals that I talked about before, where if we've got a commitment to overseas migration, the government have a vested interest in growing the population to regrow the economy. We're going to have ongoing demand for residential housing. Let's give people somewhere to live, at an affordable price point. Plus, the Reserve Bank of Australia have committed to effectively holding the cash rate at record lows until we start to see, inflation back in the target band and unemployment back down closer to 4%. So, absolutely, I wouldn't be waiting, I guess is the takeaway message. We know with record low interest rates and pent-up demand right now, market conditions are strong. We know medium to long term there's going to be a commitment to extra population growth through overseas migration. So, property doesn't go up every day or every week, but we're absolutely in the prime time in terms of growth. I think we'll look back in 10 years and say, wasn't 2021 a great time to be buying, especially when properties can hold themselves. So I hope that answers your question, Frank.
We have another question here from Maria, who would like to know, who are the lenders that finance property under a trust?
Oh gosh, trusts are something that a lot of banks did pull out of, probably in the last 12 to 24 months. They've just decided that with the growing volumes that are coming through their doors, they don't have time to train a lot of their assessors in those types of complex applications. So look, most of the big banks will do them. There's definitely some non-bank lenders and some second-tier lenders. There's enough of a spread of lenders that really you should be able to go to quite a number of banks and find lending for a trust.
Great, thanks, Amanda. Got a question here from Dan, who would like to know, is it possible to have two separate investment loans with the same bank without the two properties being cross-collateralized?
Good question, Dan.
The short answer is yes. You can the contract is linked to the particular security. So yes, you can have them separate. Most of the time that we'll just say it's more work for the broker, but it's for an asset protection point of view. If you went to the bank direct, they're going to try and join them together.
Thanks, Christian. I've got a question here from Pedram, who notes that the market is hot for selling at the moment, but doesn't look to be a good time to buy an investment property. Would you agree?
Yeah, I think that's kind of how supply and demand works, where if there's high demand, then obviously, it's a seller's market. You can capitalise on that, but you've got more competition. In a quieter market, it's definitely a buyer's market because you have less competition and more supply. The two kind of go hand in hand. The one thing that I'd suggest you think about is using the timing of the market favourably depending on whether you want to upgrade or downsize. So, if you're looking to upgrade your house, yes, you'll get a better sale price, but you'll have to pay exponentially more probably, to upgrade your house. Likewise, if you're downsizing, the gap, will be smaller if the market's quieter. So, if you're buying and selling in the same market, things will generally be the same. They're the important factors to consider.
Okay. Got a question here from Wendy, who would like to know your thoughts on investment strategies during the current COVID period with inflated prices.
Okay, so I think to the point around inflated prices, I think I answered that just a few minutes ago with the fact that yes, prices are up, 5% plus in the last quarter in all of the major capital cities. That doesn't mean that prices are inflated, and just because prices are moving at this point in time, they haven't been. They weren't last year. They weren't for periods of time before that with the lending restrictions. So try to keep an open mind on how much prices have moved, over time, and understand that there's still capacity for prices to go up. And remember, there are conservative buffers being applied at the moment to everyone borrowing money. So just because prices are going up doesn't mean that the market is inflated. Understand that the media want to sell clicks and sell papers by having headlines, and boom or bust is far more effective than there's a really balanced market right now with demand exceeding supply. So we're seeing price growth, et cetera, et cetera, et cetera. That's a boring article. This one gets people's attention. Just take it with a grain of salt in the general media and understand that anyone getting money today has ample capacity to repay it. The way that I like to summarise it, I guess, is just think about if you could have bought a property where you lived 35 years ago, would you do it? I'm yet to meet someone that says no. Generally, people say how many. Right? Just remember, in that time, though, we've seen negative gearing removed. We've seen negative gearing come back. We've seen the 1991 recession, Asian financial crisis, September 11, GFC, COVID now. Investing now and investing for the long term, you've got to anticipate that there will be other downturns down the track, right? If I told you that all of those things were going to happen, hey, before you buy this property, back in the mid-'80s, all of these things are going to happen. The number of people that would have bought would drop dramatically. So, it's never a perfect rainbow. There are ups and downs. Buy when you can. Hold for the long term. Mitigate your risk is a pretty good formula.
Yeah, and I think on that as well, it's important to borrow money when you can as well. So it's no guarantee that necessarily just because the property market stabilises maybe next year or the year after, that the bank is going to lend you the same amount of money at that point. So getting into the market and doing something as soon as you can be just as important on the lending side of things as well as the timing of the market.
Absolutely. And we talked a lot about valuations in the main part of the webinar. Valuations aren't valid for an unlimited period of time. There's a shelf life for them, 3 months typically. So if the equity exists there, don't dawdle, take it out. Even if you're not ready to move, once it's set up, the bank doesn't make you repay it. So take advantage of favourable valuations if you've got them as well.
Great, thanks very much. We got this is the second last question for the day. It's from Dan. He'd like to know what's important for someone who has a principal place of residence and wants to start a portfolio. Should the focus be on cash flow or capital growth?
Great question, Dan. So I'd actually say that the focus has to be on borrowing capacity to start with, so you understand what's possible. In terms of what you invest in, absolutely, as I said before, the focus would be on capital growth. But from an overall portfolio perspective, ensure that the cash flow is comfortable and that you can easily meet your repayments, that you have buffers in place, and that holding the extra properties that you add to your portfolio are not straining the cash flow. This is a medium to long-term journey over 10 to 20 years. If you go too hard without having those buffers in place, no one's winning if you start your journey and stop in 18 months. It needs to be something that's comfortable over the long term, with buffers budgeted for when interest rates do go up at some point in the future.
Great, thanks, Boz. Let's wrap it up here with Michael, who wants to know, how can you safely and swiftly minimise debt to be in a better buying position?
I think probably a really good start to that is, normally when somebody's looking to buy their first investment property, the common myth is go back to the lender you're with. That's not necessarily the best thing. Banks make the most amount of money off people that are complacent. They don't go and visit the market and see what else is out in the market. So they could be paying, in some instances, 0.5 or up to 1% higher than what the market is. Another opportunity is budget. How often do we see clients that haven't got a budget or don't know their living expenses? Take the time to map out a plan of attack and then work towards that goal into the future. This is not going to happen overnight. It's a big plan, and getting the right team involved is really important. Did you have anything?
I was just going to go back to our point around good debt and bad debt. So safely and swiftly minimising debt. Obviously, that would be great to minimise any debt that you do hold, which is personal debt, so credit cards, car loans, things like that. But minimising debt when we're investing is not really the goal. The goal is to kind of make that debt work for you and make sure that we're leveraging other people's money to help you get into the market.
A couple of last things I'd say to Michael. If you're an existing investor, Michael, and you have property that gives you tax benefits, make sure that you're aware of tax variation forms. Basically what they do, round numbers, let's say that you got $12,000 back in tax across your investment portfolio and you were paid on a monthly basis. A tax variation form would mean that you could get $1,000 per month extra in your take-home pay throughout the year, as opposed to covering extra holding costs and then getting a lump sum in your tax return. So if you've got your own home and there's an offset account attached to that, you having the money working for you is a way that can make a difference. Yeah. That's one thing that I would say. If we're talking about more medium to long term reducing debt, especially around your own home, I need 10 minutes to explain it now. Jump across to YouTube, how to pay your own home off in 10 years, not 30, by using what Amanda was saying around the power of compound growth for minimal cash flow out of your pocket to be able to then sell down at some point in the future and reduce a whole lot of debt in one fell swoop. I think that's it for today. Thank you for everyone, again, that sent in your questions. We hope you've enjoyed Property Financing Essentials, got some key takeaways there. And remember, if you do want to have a look at your individual situation, click on the link for the strategy session. If you've hit a wall with your existing bank or broker, you don't know what your borrowing capacity is or how you can maximise it, click on the link for a strategy session. If you want to understand how you can grow some significant wealth over the medium to long term, click on the link as well. We haven't got a get rich quick strategy. It does take time, but it's super powerful when you understand those property investment fundamentals. My team will share all of those with you. Thanks for tuning in. We look forward to seeing you next month.